What does an investment advisor actually do? Let's get into that topic right now, and let's make sure we're clear that an investment advisor in Canada is different than a mutual fund rep, and it's different than a portfolio manager. So how are they different? First of all three of those individuals can give advice. A mutual fund rep or a mutual fund dealer can buy and sell mutual funds for you. A little further up, we have the investment advisor. An investment advisor has passed the Canadian securities course, is licensed with CIRO, which is our regulatory body in Canada, and can manage clients' assets. Now, they cannot, like a portfolio manager can, they can't act as a fiduciary, and they cannot act on a discretionary basis in your best interest. So the best way to get the most and highest level of protection for your assets in Canada is to deal with a fiduciary, a portfolio manager. Someone with the title of fiduciary or portfolio manager in Canada must always act in the client's best interest at all times, every single time they're effecting a trade or making decisions on a client's account. It's the highest level of protection that a Canadian can get with their assets, is dealing with an individual who is licensed, certified as a portfolio manager. So if you're not sure, ask your advisor, ask your financial rep if they're a portfolio manager, if they're a mutual fund rep, or if they're an investment advisor. Today we're talking about the investment advisors, what they do typically, and how the clients typically pay for those fees. Now, an investment advisor can operate kind of on a commission basis. You know, they buy and sell securities and they charge you a fee to do that. We're seeing less and less of that in Canada now. The preferred model now is where interests are aligned, so where the investment advisor will charge a management fee to manage the assets. It will typically be a percentage of the assets, and that gets charged out of the client's accounts on a monthly or quarterly basis, and the advisor's firm will collect that fee and the advisor gets a percentage of that fee. That's a similar model to the portfolio managers, but it is a little different in that there's no fiduciary obligation, and typically there can be less transparency in the fees. With a fiduciary, you know that your advisor must always act in your best interest. This means there's no double dipping on fees, there's no commissions, there's no additional commissions being charged. So it's a very transparent and very clear model where you're paying for a fee. In the investment advisory world, there can still be other ways that advisors can get paid. All right, so what does an investment advisor do? Now let's assume that the investment advisor here is a fee-based advisor and they're charging a fee to manage your investments. So they would be your investment gal or they'd be your investment guy. They're building the portfolio, perhaps they're calling you up once in a while to suggest recommendations. They're making trades in the portfolio, doing reviews, maybe they're doing a bit of financial planning. Let's start at the basics. So at the basic level, security selection is probably where it starts. For most investment advisors, they are selecting and recommending securities, individual investment options for you, the client. So they're going to pick up the phone, make a recommendation. Now they typically need either some sort of verbal confirmation, or nowadays a lot of the firms are asking either signed or replied to email to get confirmation of a trade. Investment advisors that are operating as non-fiduciaries, their first kind of task of business is security selection. So that's kind of the basics. So they're going to make security selection, they're going to pick stocks, they're going to pick bonds, they're going to pick alternatives. Stocks, they might have some Canadian, US, some global, they're going to pick some of those. On the fixed income side, they might have some ETFs or some bonds or some cash. And then on the alternative side, they might deal with limited partnerships or funds or whatever that may be. But they are selecting the securities for each of those three different assets. Now, let's get to that next piece, asset allocation. Your advisor should be making recommendations based on asset allocation. How much should you have in each of those different buckets? So should you have 50% stocks or 80% stocks? You know, is that enough? Is that too much? Should you have 100% stocks? Maybe you're very conservative and you should have 0% stock. Recommending an asset allocation mix and then implementing that asset allocation mix is a big task for the investment advisor. The investment advisor must also manage cost and fees. So they must tell you, decide on how you're going to get charged. Is it going to be per transaction? Most of the advisors are likely to be doing a fee-based model nowadays, and that means you're going to pay every month or every quarter for your advice. Your advisor should also be rebalancing. So this is taking some of the assets that have maybe outperformed, trimming some of those, and allocating it to the asset classes that have underperformed. The reason we do that, obviously, is if the stock market's getting hammered and you're getting killed there with your stocks, they are now worth less. So you can and should be selling some of your fixed income and your alternatives and putting those towards stocks. Now you're buying stuff on the cheap and it's just healthy rebalancing. It's not emotional move, it's a logical move. This percentage has gone down from 50 to 45, therefore we will add to that. And same thing when the market rallies a ton. When the market rallies a ton and now all of a sudden your stocks are worth 55% of your portfolio, you trim that and you allocate it to the other sectors. It's a prudent way of managing money. It's protecting capital. It's making sure to have your client's best interests at heart. The advisor should also be managing expectations, setting expectations for the returns in each of the different buckets. Your stocks, we expect it will do this. Your fixed income, we expect they'll do that. And your alternatives, we expect they'll do this. And with your total mix, here's what we expect. Here's what historically it's done. Past performance doesn't guarantee future returns, but here's what we've done. Here's what we expect. That should be a conversation that's happening regularly with your investment advisor. As we get further down the hierarchy of advisor value, we get into an area where the better advisors are offering more valuable advice. And I would argue that once we get to financial planning advice, that becomes a core piece of the puzzle that I believe every client should have. You should have financial advice. The financial planning advice should include, financial planning, philanthropy, cash flow analysis. How are you going to get your cash flow? Where are you going to draw it from? Insurance planning. Do you need insurance? Does your corporation need insurance? Perhaps. Maybe it's a tax strategy. Maybe it's a risk mitigation strategy. What about wealth transfer? How is the wealth going to transfer from you to your next generation? Is there an estate plan in place? What does the tax bill look like on death? How are we going to wind down this corporation that you have? What about the family trust? Is anyone advising you on all of these things? What about legacy planning and succession planning? You have this business, you want to go to someone else. Legacy, you want to leave a legacy, maybe charitable giving, family trusts, permanent foundations. All of these form part of the financial planning and the wealth and estate planning discussion. Now, an advisor who's strictly acting as an advisor may be missing the boat here and might not be giving you this very important piece of advice. This is the important advice. Yes, stock selection is critical and it's my passion, and I'm very, very in love with building portfolios, and I love doing it, and I love asset allocation. I love sitting down with clients and explaining why we have these stocks or these fixed income or this piece of alternatives. But the real value for most clients comes in that peace of mind that you get from having an established financial plan, a retirement plan, a wealth and estate plan that looks at all the aspects of your wealth now into retirement and all the way until you die. Because we want to know, as Canadians, we want to know that our money's taken care of, that our kids are going to be taken care of, that the next generations are going to be taken care of, and that it's going to be done in the most tax efficient way possible. We want to preserve our wealth. We want the least amount of it to go to the government. We want to be tax optimized in every aspect of our current life. And that's what I think a big piece of the puzzle is. As we keep going down the line, there's a couple other pieces that I think an investment advisor should be doing. And one of those is encouraging consistent investments. So constantly reminding the client what their plan looks like and how they will get there. And finally, encouraging savings and encouraging proper savings behavior for the client. So I think if an advisor does all that, they're providing value, they're removing emotion from the game, they're helping you, you're saving, you're getting closer to your goals and your dreams, and that's really what we want to do as advisors. Now, I'm a portfolio manager, I'm a fiduciary, I'm a discretionary portfolio manager, so we do a little bit more than that. So check out our other videos on portfolio managers and what they do. But today we talked about what an advisor does, an investment advisor does, and we thank you for tuning in, guys. If you'd like to book a no obligation consultation, go to www.speaktorob.com, and I will see you in the next video.